If you have a 401k, a Roth IRA, or even just a couple of ETFs in a taxable account, I want you to do a weird little thought experiment with don't open an app, don't look anything up, just answer from memory. Name the 3 funds you own the most of. Now, here's the uncomfortable part. What are the top holdings inside those funds? If you can't name them, that's normal. Most people can't. And that's exactly where the risk hides, because there's a very real chance that what you just called diversified is actually a single concentrated bet in disguise on 7 companies, the so-called Magnificent 7. And I'm not saying that to be dramatic. I'm saying it because if you own an S&P 500 fund, a total market fund, a large cap growth fund, a Nasdaq fund, or a target date fund, you may be carrying the same 7 names multiple times, wrapped in different packaging. 3 funds, same engine, and that matters. Not because those companies are bad, but because the price you pay for them and the weight they silently occupy can turn an ordinary retirement portfolio into something Benjamin Graham would never call defensive. Today, I'm going to show you the Magnificent 7 risk hiding in ordinary portfolios, and more importantly, I'm going to show you how to reduce that risk without doing something extreme, without trying to predict the next headline, and without turning into a technology hater. This is about building a portfolio that can survive a noisy market, a portfolio that doesn't require you to be right about AI, interest rates, soft landings, rate cuts, higher for longer, or whatever the story of the week is. Because Graham's whole point, especially in The Intelligent Investor, was simple and brutal. You don't need brilliance. You need a structure that protects you from your own optimism when the crowd is euphoric, and from your own fear when the crowd is panicking. So here's the first thing to understand, and it's the most important. The Magnificent 7 risk is not owning the Magnificent 7. The risk is owning them in a way you don't recognize, at a price you didn't examine, in a portfolio you thought was defensive, with emotions you haven't rehearsed. That's how ordinary portfolios get fragile. Let's make it concrete. A lot of people in the U.S. build their entire financial life around one idea. I'm a long-term investor, so I'll just buy index funds. That's not a bad instinct. Low fees, broad exposure, simplicity. Those are real advantages. Graham respected that kind of practical counsel. He wasn't trying to turn everyone into a professional analyst with a spreadsheet obsession. He cared about behavior and discipline. But here's the hidden catch. Broad exposure is not the same thing as diversified risk. An index fund can be broad in name and still concentrated in outcome. Why? Because most popular equity indexes are market cap weighted. That means the companies that have already become enormous, often because their stock prices have risen faster than everything else, automatically become a larger percentage of the index. It's like a voting system where the most celebrated voices get a megaphone, and every time the crowd cheers louder, the megaphone gets bigger. Over time, your passive portfolio becomes more active than you think. It's actively chasing yesterday's winners by design. And when a handful of mega cap stocks dominate market value, they dominate your returns. They dominate your risk. They dominate your emotional experience. This is why 2 people can both say, I'm in index funds, and one of them is quietly running a concentrated growth portfolio while the other is closer to something balanced. The label doesn't tell you the exposure. Now, you might be thinking, okay, but these are great businesses. They might be. some of them are exceptional. And that's where Graham's message gets even sharper, because Graham never confused a great business with a great investment. A great investment requires a reasonable price. It requires a margin of safety. Graham's classic definition of investing is something like, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Notice what's missing. It does not say a company with a great story. It does not say a company everyone agrees will shape the AI future. It does not say a company that's in every headline. It says safety. It says adequate. It says analysis. So the first trap in the Magnificent Seven era is what I'll call the quality hypnosis. When something is obviously important, like smartphones, cloud computing, digital advertising, AI chips, the mind quietly does this. Important product, therefore important company, therefore safe investment, therefore any price is fine. That final step is the error. Price is what you pay. Value is what you get. And in markets, the most dangerous moment is when everyone stops asking, what am I paying for this? And starts saying, you can't miss this. That's not investing. That's narrative. Now here's where the risk gets sneaky. And I want you to really feel this. Most people didn't wake up and decide, I want 35% of my U.S. stock exposure tied to 7 mega-cap names. They didn't choose it. It happened to them. It happened because their 401k plan offered a menu of funds that looked different but overlap heavily. So you pick an S&P 500 fund because everyone recommends it, a total market fund because it's more diversified, and a large cap growth fund because it has the best performance chart. And you think you built a 3-part strategy. But if the top holdings are the same, you didn't build 3 strategies. You built 3 mirrors pointed at the same 7 companies. It's like owning 3 different SUVs and telling yourself you're diversified because they have different brands. Then realizing all 3 share the same engine, the same transmission, and the same single point of failure. If that engine stalls, you're not a little inconvenienced. Your whole garage is down. This is the first practical test I want you to remember, because it's a Graham-style move. Don't trust labels. Inspect substance. The overlap test. If your biggest funds share most of their top 10 holdings, treat your portfolio as one position that's been divided into multiple containers. That's not a moral judgment. It's a diagnostic. Now let's talk about why it matters. Because if you're 23 and contributing a little every paycheck, you might say, so what? I've got decades. But if you're a normal middle-class investor, say you started late, you're catching up, you're 45, 50, 55, this becomes far more serious, because the market doesn't just test your returns, it tests your timing without asking your permission. This is the part nobody wants to think about. Sequence of returns risk. 2 investors can earn the same average return over 20 years, and one retires comfortably while the other runs out of money, because the bad years happened early in retirement for one of them. If your portfolio is quietly concentrated, the bad years can be worse, and the emotional pressure becomes heavier. And that's how even disciplined people break their own plan. This is why Graham cared so much about the defensive investor. Not because the defensive investor is timid, because the defensive investor is realistic. The defensive investor assumes Mr. Market is going to do something outrageous at some point. Not maybe, not if, he will. And Mr. Market, Graham's famous metaphor, doesn't just fluctuate. He seduces. When markets are rising, Mr. Market doesn't say, "Be cautious." He says, "You're late. Everyone else is getting rich. Don't miss it." When markets fall, he doesn't say, "Great time to rebalance." He says, "This time is different. You were wrong. Get out before it gets worse." So if your portfolio is concentrated in a handful of high expectation names, Mr. Market's voice becomes louder because your day-to-day swings get bigger. That's the second hidden risk, behavioral risk. Not just volatility, but what volatility does to your decision-making. Now let's peel back the magnificent 7 risk in layers, because it's not one thing. It's multiple risks stacked on top of each other, and they reinforce each other. First layer, concentration risk. Even if those 7 companies are in different industries, their stocks can move together because they're owned for similar reasons: growth expectations, innovation narratives, and sensitivity to financial conditions. Which brings us to the second layer, interest rate risk. This is where a lot of investors get confused. So let's make it simple. When you buy a stock at a high valuation, you are paying today for cash flows you expect far into the future. The further into the future the market is pricing the return, the more sensitive that price becomes to discount rates, meaning interest rates, yields, and the overall cost of capital. When rates rise, the math becomes less forgiving. When rates fall, the math becomes more forgiving. That doesn't mean you can predict stocks by predicting rates. It means if your portfolio is dominated by long-duration equities, stocks priced for far future growth, you're implicitly exposed to the rate story whether you like it or not. And in a world where headlines swing from rate cuts are coming to higher for longer, to inflation is sticky, to soft landing confirmed, to recession fears, your portfolio can get yanked around by macro narratives you never intended to bet on. Third layer, valuation risk, what Graham would call the shrinking margin of safety. If you buy something at a price that requires perfection, the margin for disappointment is thin. This is the part most people avoid, because it sounds like you're saying the future won't be bright. No, the future can be bright, and the investment can still be risky, because the question isn't, will AI be important? The question is, what did you pay for the privilege of owning that importance? And the market, in its manic moments, tends to pay not for importance, but for dominance plus inevitability plus speed, as if the future is already cashed in. Graham would look at that and say, you're removing the cushion that protects you when reality arrives at a slightly different angle than the story. Fourth layer, portfolio duplication risk. This one is almost comical once you see it. A lot of people own a total market index fund, an S&P 500 fund, a tech sector ETF, and a growth mutual fund. They think they're diversifying across multiple vehicles, but they're doing the financial equivalent of ordering the same meal 4 times because it comes on different plates. And it's not just about the Magnificent Seven, it's about factor exposure. If most of your equities are large cap growth, then you don't really have multiple equity strategies. You have one, I hope large cap growth keeps outperforming. That can work for a while, and then it can stop working right when you least emotionally can handle it. Now, here's the part that usually makes people defensive, so let me say it carefully. I'm not telling you to sell everything. I'm not telling you to boycott the biggest companies. I'm not telling you to time the market. I'm telling you to stop being accidentally concentrated. There's a big difference between I intentionally choose to own these businesses at these weights for these reasons, and I woke up inside a portfolio shaped by a market cap algorithm and a performance chart. Graham's approach is intentional. Even when it's simple, it's intentional. So let's move to the practical thing, the defensive investor retirement blueprint for the Magnificent Seven era. And I'm going to give you 3 paths because different people have different constraints. But first, there's one rule that sits above all 3 paths. If you remember nothing else, remember this. Your goal is not to maximize returns in the good years. Your goal is to avoid catastrophic decisions in the bad years. Because the catastrophic decisions don't just reduce returns, they delete decades. That's the real risk hiding in ordinary portfolios, not the 7 companies, but the moment you panic because your safe plan didn't feel safe. Path 1 is for the investor who wants to stay mostly in index funds and ETFs. Keep it low fee and keep it simple. This is indexing with Guardrails. Step 1, remove duplication. If you have an S&P 500 fund and a total market fund, you probably don't need both. They overlap heavily. If you have a total market fund and a large cap growth fund, understand what you're doing. You're overweighting the biggest growth names, often Magnificent Seven. You can still do it, but do it consciously. Don't do it accidentally. Step 2, add true diversification, meaning different sources of return. In practice, that can look like pairing a broad U.S. equity fund with an international fund, adding small cap value exposure if available, or using an equal weight approach for part of your U.S. allocation. The point isn't to chase the best performing segment. The point is to avoid having your future depend on one narrow engine. Step 3, add ballast. Graham never treated bonds and cash as embarrassing leftovers. He treated them as part of the defensive architecture. If you're close to retirement or you simply want a portfolio that doesn't bully you emotionally, you need something that behaves differently from equities. That can mean high-quality bonds, treasuries, short-duration instruments, T-bills, or a money market fund, depending on your options, and yes, sometimes just cash. This is the boring edge. Because when Mr. Market is screaming, boring is a superpower. Bonds and cash don't exist to make you feel clever. They exist so you're not forced to sell stocks at terrible prices. That is literally margin of safety applied at the portfolio level. And notice how Graham thinks. Safety first, then return. Not because he hates returns, but because returns without survival are fantasy. Path 2 is for the investor who wants a clear, rules-based defensive allocation, especially relevant for a real-life middle-class investor with a job, a family, and limited time. This is the defensive investor allocation bands approach. Graham famously suggested that the defensive investor keep a meaningful allocation to high-grade bonds and a meaningful allocation to common stocks, adjusting within a range rather than swinging wildly based on predictions. The modern translation isn't copy a number. The modern translation is set a range you can live with and rebalance inside it. For example, you might choose an equity range and a bond and cash range that fits your risk tolerance and your timeline. If you're younger and stable, maybe equities are higher. If you're closer to retirement or you started late, maybe you want more stability. The key is this: decide the range when you're calm and obey it when you're emotional. That's what makes it defensive, because when stocks soar, your equity allocation grows above your range and rebalancing forces you to trim. When stocks crash, your equity allocation falls below your range and rebalancing forces you to buy. That is the opposite of what most humans do naturally. Most humans buy more after it went up and sell after it went down. Rebalancing is a mechanical way to turn Mr. Market's mood swings into your discipline. And in a magnificent 7-dominated market, it also prevents one group of mega caps from silently becoming your entire plan. Path 3 is for the investor who's tempted to pick stocks. Maybe you enjoy analysis. Maybe you want more control. Maybe you're tired of blindly owning whatever gets the biggest weight. This is where Graham's checklist matters. And I'm going to be blunt. If you are going to pick individual stocks, you don't get to be lazy about price. You don't get to rely on vibes. You need a framework. Graham's approach in plain language asks, is the company financially strong? Is it stable? Is the price reasonable relative to what it earns and what it owns? Is there a margin of safety? A modern simplified Graham-style screen might include a healthy balance sheet, manageable debt, strong liquidity, a history of profitability through cycles, earnings or cash flow that isn't purely a promise, and a valuation that doesn't require miracles. And then, even if you love a business, you ask the question most people avoid. What would have to go wrong for this to be a bad investment? That question is not pessimism, it's risk management. It's how you refuse to pay a speculative premium, because speculation often looks respectable in a bull market. It wears a suit, it uses words like disruption, it hides inside ETFs. It sounds like certainty, but Graham would tell you, if you buy without a margin of safety, you're renting confidence from the crowd, and the crowd always sends the bill later. Now, before you think this turns into sell the Magnificent Seven, let's correct the most common misunderstanding. Graham's philosophy does not require you to avoid famous companies. It requires you to avoid famous prices. That means your answer might not be never own them. Your answer might be own them, but don't let them become your entire identity. Own them, but with guardrails. Own them, but not at any weight the market hands you. Own them, but with a portfolio that can breathe if they underperform for a while. Because yes, even great companies can underperform for long stretches, not because they're failing, but because expectation got ahead of reality. And this is where the title of this video becomes personal. The risk hidden in ordinary portfolios is not a scandal, it's math plus psychology. It's the invisible concentration plus the visible temptation. So let's turn this into a quick action plan you can actually follow. Starting small, starting late, whatever your situation. Here's a simple, practical Graham audit you can do without needing to be a pro. First, count your unique equity engines. List your main equity funds. Then ask, are these meaningfully different? Or are they all large cap growth in different wrappers? If they're mostly the same, simplify. Complexity is not diversification. It's often just confusion. Second, cap your theme exposure. Even if you love AI, even if you think big tech will dominate, even if you're right, cap it. Why? Because a theme can be true and still be overpriced for long periods. Capping is how you remain an investor rather than a believer. Third, build your ballast on purpose. Decide what percentage of your portfolio exists for stability and optionality. Stability means you can endure volatility without panic. Optionality means you can buy when other people. That's why cash and high-quality short-term instruments are not dead money in Graham's world. They are dry powder. They are emotional insurance. Fourth, rebalance a professional even. If you're not one, pick one method. Calendar rebalance once or twice a year. Or threshold rebalance if something drifts too far from target. The goal is not precision. The goal is obedience. This is how you stop the Magnificent Seven from silently growing into a monster position after a strong run. Fifth, control the two silent killers, fees and frenzy. Fees are obvious, but they compound quietly. Frenzy is less obvious, high turnover, constant changes, chasing hot funds, buying story stocks because the narrative feels safe. In Graham's language, that's drifting from investment into speculation. And speculation is not evil. It's just expensive, especially when it's accidental. Now, I want to bring Mr. Market back into the room because this is the part that actually decides your outcome. Imagine it's 2 years from now. You open your account and the market is down hard. Your S&P 500 fund is down. Your total market fund is down. Your growth fund is down. Your tech ETF is down. Everywhere you look, the same names are bleeding because the same names were the core of everything you owned. You feel a tightness in your chest, not because you don't know the market goes down, but because your diversification didn't behave like you expected. That's the moment ordinary investors make extraordinary mistakes. They stop contributing. They sell near lows. They swear off stocks forever, or they do the opposite. They double down blindly, not because the price is now attractive, but because they need the story to come back so they can feel okay. Graham's defense against that is not a prediction. It's a plan you can execute even when you're scared. This is why the margin of safety is more than a valuation concept. It's a lifestyle concept. It means you build your finances so that you don't need perfection. You don't need the Magnificent Seven to keep rising. You don't need AII to monetize on schedule. You don't need the Fed to cooperate. You don't need the market to reward you immediately. You need a portfolio built to tolerate being early, being boring, being ignored, so you can stay rational. Because being rational is the only edge most investors will ever have. And it's the best edge. Now, let's be honest. A lot of people watching this are not trying to beat the market. You're trying to not get destroyed by it. You're trying to retire with dignity. You're trying to protect your family. You're trying to stop feeling like your future depends on the mood of financial Twitter and a handful of earnings calls. So here's a simple sentence to keep in your mind, especially in a market dominated by mega caps. A defensive portfolio is not one that never falls. It's one that doesn't force you to make a life-changing mistake when it falls. That's what Graham gave people: practical counsel, not excitement, not hype. Practical counsel. And that brings us full circle to where we started, the 3 funds in your head. If you remember nothing else from this video, remember this: different tickers are not diversification if they are the same underlying bet. Different fund names are not safety if they hold the same top holdings, and everyone owns it is not a margin of safety. What do you do with that? You don't panic. You don't need to predict. You don't need a heroic move. You do something almost insulting in its simplicity. You look under the hood. You remove duplication. You add ballast. You set ranges. You rebalance. You stop paying for perfection. You refuse to let Mr. Market set your emotions. And suddenly, the Magnificent Seven stops being the invisible center of your financial life. They become what they should have been all along, just part of the market, not the market in your plan. Because the real win isn't bragging about your returns in a good year. The real win is being calm in a bad year. That calm is not personality, it's architecture. This is Benjamin Graham Invest. And if you want your next step to be crystal clear, do this after the video. Open your main funds and look at the top 10 holdings. If you see the same names repeated across everything, you just found the hidden risk. Then simplify and rebuild with guardrails. Margin of safety at the portfolio level. Not to be perfect, to be unbreakable enough to stay in the game. Because in the end, your goal isn't to be right. Your goal is to still be standing when Mr. Market is done yelling.